Hey, it's Joshua here with another edition of Mortgage Clarity. And today I'm going to talk about the four C's of lending. What the four C's are essentially is the four main things that in general the lender is going to look at when determining whether or not they're going to grant you a home loan. Now, each of one of these, of course, break down into much more detail, but this is essentially the underwriting process. So the first thing we're going to look at is what's the borrower's credit? How's the credit? Credit scores can tell the lender whether or not you look to be a good credit risk based on how you treated credit in the past. Now, while credit scores are important, it can have an impact on whether you qualify or not qualify, or maybe you qualify, but what's your interest rate going to be or what your mortgage insurance is going to be. It's not just about the credit score. It is actually possible to have technically an acceptable credit score, even like a 700, and still not meet the credit requirements for the lender. So what they're looking at in that sense is also, do you have the score, but do you have enough depth and history? So a borrower who might have a score, but they only have one trade line and it's only been open for maybe 9 months, so they do have a score, but that's all they got. That's not really a valid score from a lender's perspective because there's just not enough depth and history there. So depending on the program, you might need to have at least one trade line open for 12 months before that score is valid. Or other programs, it's 2 to 3 trade lines open for 12 months before it's a valid score. Now, before we move on from this one here too, it is possible to have multiple trade lines open for more than 12 months, have an acceptable credit score, and still not have an acceptable credit report. So we also are looking at what's happening. So maybe you have a 620 credit score that meets the requirement for the program, but the reason you have a 620 credit score is because you had a 90-day late recently, or maybe a 90-day late on a mortgage payment. The type of lates you have, some mortgages are very, of course, of concern to a lender. Those types of lates are more scrutinized than a 30-day late on, say, a revolving credit card. So if you have too many lates within a short amount of time, regardless of having a score, you may not pass the credit part. Okay, so credit. So moving on, let's talk about capital. Capital has to do with basically your skin in the game. Do you have enough money, capital, in your account to meet your down payment requirement, closing costs, and prepaids? Those are the most common ones. Now, some programs allow for no money down. So for example, VA and USDA, it might be possible to get in with very, very little capital. I have helped clients get into like a USDA loan where they only had about $300 in their checking account, and the closing costs were built into the offer price. The seller paid closing costs. USDA had zero money down. They didn't need any reserves. They got in with only $100 of capital in their account. So you don't necessarily need a lot of capital, but this is something we're going to look at depending on the program. As you get into different programs, you might find that, again, if you can't get the seller to pay the closing costs, you'll need that, or you might need 3.5% down if you don't qualify for the zero down programs. Also, as you start to get into things like investment properties, in addition to down payment and or closing costs, there's what's called reserves. And that basically says on a program like an investment property, they might say that when everything's done, we want to know you have enough money left in the bank to cover maybe 3 months worth of house payments or whatever the case might be. So that's a requirement. That's what they look at. So that's capital, money you have to be able to get into the program, and if necessary, have left over after you close on the loan. So the next one has to do with capacity. So capacity is really gets down to how much home can you afford. So this has to do with debt to income ratio. And again, this is a very general overview right now. There's a lot more goes into it because the way you look at income is going to be different, likely, or can be different than the way the lender will look at income. So they may not use all the income you have, or they actually might use more income you have. If you have, non-taxable income, the lender might actually gross that up and use more. So you got to work with your lender to figure out what your income is. But once you know what the lender can use for income, you then look at that as a percentage of the debt that you have. So what do you have for car loans? What do you have for credit cards, student loans? All that kind of stuff that they're going to look at. What they don't look at is they don't look at what you spend every month at restaurants or Starbucks or your cell phone or your garbage or water. They don't look at that. They look more at installment and revolving debts that you would have most commonly seen on your credit report, but not always. There's sometimes that you might have that doesn't show up in the credit report that would be factored in. So once you know what your income is and you know what your existing debt is, based on the program, how much more debt can you take on before you exceed an acceptable risk? Because again, a lender does not want to make a loan that they think you might default on. That's not good for anybody. It's not good for you. It's not good for them. So they're going to look at that and decide how much additional debt. Once you know that, let's just say based on your capacity, you can take on an additional $2,500 of debt. Then using that number, the lender can kind of work backwards to help you see what does that look like as far as a price point. So based on your down payment, your credit score, mortgage insurance, taxes, homeowners insurance, all that stuff, take it all into account, what's left over for principal and interest, and then do the math. And there's how you get to your price point. So usually when we talk about a borrower being qualified for a price point, it's not the price of the home. It's either going to be the debt ratio, the monthly payment for the capacity, or the amount of money they need to get into it if they don't have the collateral, the capital to get into it. So the last C we're going to talk about today is collateral. So even if you have great credit, even if you have low debt ratios, and even if you're putting a huge down payment down, so it looks great, you have to make sure that the property is actually going to meet the minimum standards for the lender. So just because you have great credit and great down payment doesn't get away from the fact that if the home's in shambles, the lender's not going to want to deal with that, because the home is there to, one, make sure that there's enough value in the home that should the lender have to foreclose, it's reasonable they're going to recover their loan amount once they take that property and sell it, if it came down to that. But also the other thing has to do with the condition of the home, because maybe the home does have the value, particularly given if you're doing a large down payment. But if it has like a bad roof on it and it's leaking and it's got bad siding, these are all things that tell you that if it's not fixed, the home's only going to get worse in the future. And so the lender is going to make sure that that home not only has the value to support the loan, but it's in an acceptable condition so that the likelihood of it being ran down isn't there. So that's how you get to the 4 C's. So again, you can just recap, you have capital, credit, capacity, and collateral. That's the main thing that a lender is going to do and underwrite each of those different components. And once you meet all those, loans should look good. So I hope you found this video helpful. If you did, be sure to thumbs up. If you got questions or follow-up questions, please drop those down in the chat box. I'll be happy to respond to those as I see them. And until next time, have a great day.